Alright, hello and welcome. I know last time I tried to do a short form video and it ended up 40 minutes. This time I'm going to try and do a short form video and see if it ends up shorter than 40 minutes. Straight off the bat, right, I don't really like this investment at all. It's not something I'm going to be investing in, but I did spend a reasonable amount of time trying to understand this business and try and understand the some strange looking parts of it, so I thought I might as well talk about it because I put the effort into trying to learn it, so I might as well put that out there on my blog of my journey. The company is Celanese Corporation, came up on the same screener that we used last time to bring up WPP, Crocs as well, which is another video that I've done previously, and Civi as well. So yeah, the Celanese Corporation is a chemical business, global chemical and specialty materials company that operates primarily through the manufacture and sale of differentiated chemicals, polymers and specialty materials. So basically got two main portions of their business. One is I don't know how to pronounce this, is it acetyl or acetyl? Because obviously I'm an engineer and we use acetylene, so I'd say acetyl, but I don't know if it's acetyl or acetyl, but acetyl chain. Basically acetic acid, vinyl acetate, so basically it ends up in paints, adhesives, construction, textiles, paper, packaging, in general industrial chemicals, and the other part of it is engineered materials, which focuses on higher value materials, plastics, polymers for automotive, electronics, telecommunications, medical devices and all that. So I've got funny feelings about 55% of their revenues are in the engineered materials section, and about 45% are in the acetyl chain thing. It's a global player, global business, so there's no real geographic breakdown of their. I'm sure there is, but I've not looked into it because it's business. Like I said, I've tried to understand it. I've put the effort in, so we're doing the video, but I've not done a huge deep dive on the geographic nature of their sales. They do say sales almost equally divided between North America, Europe and Asia, so that's what we went with. Down to future risks, what this company could face is very cyclical demand, raw material, feedstock cost inflation, pricing pressures. So I've got a funny feeling they rely a lot on hydrocarbons as feedstocks. Natural gas, methanol prices directly affect the cost of sales. And a huge forward risk is global economic uncertainty, interest rates, China's industrial slowdown, EV adoption speed, things like that. Automotive, construction, electronics, packaging, any sort of slowdown in that, and Celanese is going to feel the impact of that. There's quite a few other things here, like you could pause the video and read, but commodity prices, oversupply risks, energy costs, like I said, cyclical demand, persistently a high risk, that one, and it's a highly leveraged company as well, which we're going to get into. It has had a huge decline in price. What are we talking, May 2024, so the last, what's that, 14 months to 16 months, 75% drop in price, and just in the last few months we've had like another 30% drop. Tried to rebound a little bit, we've had another 30% drop, so doesn't look good. The stock price doesn't look good anyway. So where are we going? So what have they been doing to try and combat the decline? 80 to 90 million in cost savings annualized. They've reduced the head count and they're trying to make SG&A savings. Dividend was cut by 95% to strengthen the balance sheet. Now, like I said, with WPP, and a dividend is not really something that bothers me. If I was an investor, I'm sure I'd feel completely differently. But as a business that's trying to survive, trying to save money, to cut a dividend, I think is a pretty smart decision to do. You can see there that it used to be 70 cents per share, and now it's literally 3 cents per share, so they've really cut it back, which obviously pisses off his investors. A lot of people would just get out of it now. They'd be like, what's the point in owning it? prices declining, dividends gone to dog shit. A lot of people would just get out of it on that. So they're trying to control working capital, inventory reduction in the engineered materials segment. There's a new CEO as well this year in January. 2025 that was. So they're targeting growth markets such as electric vehicles, clean energy and high performance polymers. That's obviously to try and boost their engineered material segment, because the engineered material segment, I believe, is the that's causing the problem. I don't want to skip down too far, but yes, it is the part that's mainly causing the problem. The success of these initiatives depends heavily on the external demand conditions and the company's ability to execute the shift in its business mix. ChatGPT said if it was to highlight one key area to watch, it would be the higher margin engineered materials, so they start delivering meaningful revenue margin lift in the next 12 to 18 months. But yeah, some of what they're trying to do to combat the decline, some of the risks that Celanese comes up with. So balance sheet, right? I try to start on the balance sheet quite often. EV is huge. Am I on the right one here? No, this one here. Enterprise value is huge. Okay, the market cap is around 4.5 billion. Enterprise value is 16.6 billion. There is an awful lot of debt on this business. That potentially definitely has potential to cause them a lot of problems as well. We'll go into that. Long-term debt is 13 billion, and TTM interest expense is 700 million. Down here, look, interest expense 700 million for the last 2 years, 3 years really. So, 686 million. That's huge. And I've worked out as well that we'll get into it, but I've worked out as well TTM interest expense of 700 million. Their current TTM free cash flow is only 608 million. So potentially a problem. Not good. What's the next bit? There you go. Yeah, see, so TTM free cash flow. It has a revolver of 1.7 billion, which apparently none of it is currently drawn. So the debt, 926 million matures in 2026. 2.5 billion due in 2027, 1.5 billion matures in 2028, 1.3 billion matures in 2029, 1.7 billion in 2030. That's a lot of debt. And if you're only making currently 600 million and you've got, what have they got, 1.7 billion on a revolver, and what's their current cash holdings? 1.1 billion. They're going to struggle to pay that off. Now, what I find quite interesting about this, which is one of the things that I did actually want to talk about, is that the bonds, Celanese's bonds, which obviously these are the ones that are maturing that I've just mentioned. Look at the latest sale price of them all. All of them basically trading just below par or just above par. Now, for a company that I don't believe is going to be able to pay any of these maturities, potentially some, let's not say any, but potentially some, I thought, wow, the bond market is not seeing any risk at all in this company. Now, I did run that through ChatGPT as to why. Basically, ChatGPT came back saying that the bond market is not looking at being able to pay it back. They're basically looking at it like it's going to get matured, and it's almost certainly going to get matured. That's what the bond market must be pricing in. As I say, bonds all trading close to par. Only 1.1 billion in cash is available, and 1.75 billion revolver. No chance of paying back with current simple free cash flow. ChatGPT, this is unsecured as well. Unsecured, this is. But ChatGPT reckons that the replacement cost of CE is like of 15 billion, and the bond market views this as collateral-like, even though the bonds are unsecured. So basically, they're betting on refinancing and not repaying the maturities. Short-term assets are reasonably liquid. It's basically all cash, receivables, and inventory. Which it's the wrong one. It's another one I'm looking at the moment. It's probably going to be the next video. 1 billion in cash, almost 2 billion in net receivables, 2.2 billion in inventory. So depending on what you mark down that inventory as, if you're going to sell it off in a fire sale, the current assets on the balance sheet are reasonably good. I think it's high quality stuff generally. Long-term assets, I don't think they're very great. There's 5.6 billion in PP&E, but 9 billion in goodwill and intangibles, which means tangible book value is severely negative. Here, minus $32 when 2022 it was $30. Now, I haven't wrote in there what caused all this, but wasn't it? I believe it was the purchase of part of a DuPont business that caused all this. I should have wrote that in actually, to be honest, because that's quite a significant factor. I will make a note to put that in. So basically, that's what's caused this. I believe they've bought out a portion of DuPont's business. Massive goodwill on the books. Debt went through the roof in doing it. But that is where they are at. The bonds are slowly have recently been downgraded and are basically just on the cusp of still being investment grade. Are mainly secured with no covenants that could force early repayments. So there's no debt ratios that had to be met. And they've saved around 300 million per year by cutting the dividend, which obviously is going to help towards the payment of these bonds. 300 million from the free cash flow doesn't have to be spent. So there's 7 billion of notes that's going to come out in the next 3 years, and the current average cost of debt is around 4%. But that's basically on my cost of debt figure here. When you actually look at some of the payments on some of this debt, it's like 6%, 7%. So it's quite high. So there was a huge impairment charge in 2024 of almost 1.7 billion. Basically fucked the return on capital for the EBIT, because obviously that is the way it is put on the income statement. Where are we here? I'm on the wrong bloody one again. It's going to happen a few times during this video, I'd imagine. Yeah, so it went negative. EBIT, where are we? Operating income there, negative. This was it comes under other expenses on my thing, but they had a 1.75 billion write down in goodwill, and I can't remember what it was. Assets, I believe. I think it was mainly in the goodwill. Can we see that? Yeah, so significant portion in the goodwill, some of it in the intangible assets. A huge impairment charge, which obviously affected the EBIT. That's a one-time thing generally, right? Well, is it a one-time thing with the amount of debt that they've got, the amount of goodwill that they've got? Technically, you would class an impairment charge as a one-time thing. So if you actually took the impairment charge out of it, if I wrote this in here, so moving down onto the income statement, this is a huge impairment charge, 1.7 billion, massively impacting earnings. But financial year 23 also had a gain on asset sale, 505 million, which is also non-recurring. So 2024 looked worse and 2023 looked better. But without both of these, operating earnings would have still been around 1 billion for 23 and 24. So like I said, 23 was boosted by a one-time sale, one-time financial, one-time income, and 2024 was suffered from a one-time, basically non-existent expenditure, which has to be taken out in GAAP accounting. So it still would have been around 1.1 billion. So the actual, without that, and without both of those things, the actual return on capital would have been, for EBIT, would have been reasonably unchanged. So that needs to be taken into account. The only thing I ever wanted to notice, because I did jump a bit, only affects EBIT, not through book value, is taking a dive because of this 27% drop in equity value. So obviously, book value includes goodwill and intangible assets. 1.7 billion's gone, so you've got 27% drop in book value because of this impairment charge. On the income statement, revenues declined 5.8%. There you go. What else have we got? There was a slight improvement in cost of sales. 540 million revenues decline in engineering materials and 120 million decline in the acetyl chain thing. So the largest portion of the problem with this company is in basically the automotive engineering sector. Said there, so 600 million decline in total. This is TTM, by the way. I don't know if I mentioned that before. So talked about a huge impairment charge. There was a slight improvement in interest expense, but interest expense is still huge. I spoke about that there. The core operation's not as bad as it seems because of the impairment charge. The next significant portion of earnings difference is in the taxes. Financial year 2022 and 2023 appeared to have used deferred tax assets to boost earnings, which was unable to be used in this year because of the jurisdiction that it can be used in, I believe. This is one of the things that I was getting a bit confused about, which I spent a lot of time on, was having to talk to ChatGPT about deferred taxes, assets and deferred taxes, because it's not really something that I'm up on. Obviously need to be, especially when you're looking at businesses like this. But so get a revenue drop, and then a lot of the other portion of revenue missing was because of things like tax assets that have been used previously and not been able to be used this year. The cash flow statement, let's move on to that. Impairment and taxes haven't really impacted the operating cash flow. The big changes apparently were in the working capital. There was a large swing in payables that was negative. They basically extended payables by 13 days. So let's get this up and have a look. Cash flow statement down here. So payables were 330 million positive last year, and obviously they spent 295 million on payables this year, so that's a 600 million swing. What was the other thing I mentioned just then? Already forgotten. Oh yeah, working capital side of it. So I've got a working capital analysis page where, pardon me, I look at day sales outstanding, day sales of inventory, day sales of payables. So TTM, day sales of payables, has actually got slightly better, but it is worse than what it was, a couple of years ago. What is the average? Here, 57. So I suppose it's 60. It's not that bad, really, is it? They're slowly, it's taking a bit longer to take the receivables on. Receivables changed slightly as volume sales fell. So in all, there's about 700 million swing year on year in working capital that negatively affected the TTM free cash flow. Dropped about 400 million year on year. We can see that. Where is my mouse? See that here, down a billion, down to 600 million. Quite a significant change, especially when your interest expenses are around 700 million. Not great. So EBIT to EV yield is negative. Obviously, that's because of the basically impairment charge. Simple free cash flow to EV yield is 3.6%, so that's less than the 10-year treasury. So historically, it's much higher. So basically, CE is in a trough earnings wise. You can see it's where have I got it here? There's a 3.6%. So historically, it would be, looking at this, 17, 9, 10%. So they've had a decline in the business, but obviously the enterprise value has changed massively in this time. Here, look, 8 billion doubled. So that's going to be a significant portion of it as well. This changed that. Basically, one of the main things that's changed it. I know simple free cash flow has dropped, but when you're looking at a billion-ish around about, the main thing that's changed is the enterprise value is just fucking skyrocketed. So it's trading significantly higher than historical multiples against EV, particularly currently. Obviously, the simple free cash flow has dropped. What was the historic multiple? So quite low on market cap this is, but on EV, the past few years, 17, now it's 27. So what would that be? Well, 16 average over the 3-year average is difficult when you take an average over 3 years. You should be taking it over longer, really. But yeah, not great. And that's all because the enterprise value hasn't changed much in the last few years, but the simple free cash flow has. So multiple significantly high at the moment, even with the price where it currently is. So the next thing I did was went on to the peers, see what the peers were doing. Now I have used, you can tell me that I'm wrong to use this, but I have used EMN, AKE, which is in France, but I believe the ticker is something different actually. On at least on my data, we'll look at that in a second, and BAS in Germany. What I'd say one of the other things I noticed, right, is that only less than 1% of insiders own it. Don't like that. It's not something I like at all generally. There has been some insider purchases. You can see here, nothing really of significance. I say that these are quite low dollar values really for the size of the company. There's this one here, 407,000 earlier on this year. Will that be March? I don't know, because this is American in it, so they do it back front to us. But yeah, March. That's quite a significant. What was that? 55 compared to where we are now. 54 compared to where we are now. So it's 30% higher. So at that point, somebody in Celanese thought, oh yeah, this is a good place to buy in, which is obviously not turned out to be the case. But it depends on what your timescale is, doesn't it? As usual. Short term has not turned out to be done very well, but look where they have historically traded, significantly higher than where it is now. So yeah, under the peers, now I can show the peer performance along here, but basically the entire industry is apparently under pressure. There's demand weakness, margin pressure, cyclical downturn. The French one, Arkema, appears to be handling it the best, per ChatGPT. As appears in general under pressure, this makes the debt even more precarious. So it has by far the highest debt load, and let's get this up here now, because I've got a wrong one again. So EMN, BAS, and then RK there. So like I said, it's different on ticker's different. So debt capitalization, right, 71% is Celanese's capital structure is debt. Now that's significantly higher than peers, significantly higher. Highest EV to sales, highest price to book. None of the others have got a negative tangible book value. Worst EBIT to EV, but like we said, that's a tough one considering what's happened with the write down. Simple free cash flow multiple, it's not higher than EMN, so it's not the worst one, but look at where the others. Well, actually, it's actually second best because 127 times for BAS. So gross margin is not the worst. It's probably around about average. Operating margin doesn't look too bad either, compared to the peers. The income margin also doesn't look too bad, so it's not all bad, operating cash flow margin is the highest out of the peers. Simple free cash flow margin, so this is all 3-year averages, by the way, the highest of the peers, so there's silver linings to it. Simple free cash flow margin though is significantly lower than RK and around about what the others are. Yeah, so let's see what else I wrote on the peer analysis. Without the impairment charge, EBIT multiple would actually be the second lowest, and the free cash flow to EV multiple is also the second lowest. EBIT to ROC is on the lower end of peers, but free cash flow to ROC is second best. Gross margins are on the average, so costs are no worse than their peers. Operating margin is the same. OCF margins with cash margin are the highest of the peers, so there are some upsides. Debt is a major staller of this stock. But capital's there, that's my opinion at that point. So they haven't given any revenue guidance, but they're expecting to make 700 to 800 million free cash flow. So if you're looking at no significant margin changes, you're looking at probably the revenue still being in the 10 billion range. So 12% is apparently 7-year averages, and that's like so. Or free cash flow margin. Sorry, I'll finish that sentence before I stall. So yeah, 12% there. So obviously that's averaged over 7 years. So this is a highly cyclical business. So you could say that that margin is, I don't know, would it be mid-cycle? There have been periods where it's been higher. I wrote down here anyway, so that because ChatGPT, this was, me talking to ChatGPT. I use AI a lot because I don't have anyone to connect with, unfortunately. I'd like to have more people to connect with, which is all the point of doing this. I'm trying to learn, trying to become an investor. 12% simple free cash flow margin, 7-year average is like a mid-cycle average according to ChatGPT. So currently way above the current level, but reversion to the mean. Obviously, cyclical improvement means that this should be potentially where it ends up again when the cycle changes. So obviously that's positive. That would be better for the business. Using the JG multiple free cash flow comes out around 600 million using 80% of the average margin. So let me just explain what I've done here. I've used 8.5 billion revenues, even though we think it's going to be closer to 10. I just like to try and be conservative. I have then 3-year simple free cash flow margin. What have I done here? 0.7. I just wanted to see what it'd be like to get back to where we were, mid-cycle, because it was around about 1 billion, wasn't it, the free cash flow? So I've just left that in there by accident, that's all. So 80% I used. Not 80% of it. Around 600 million, which would basically give it a future simple free cash flow multiple of around 7.5, which I believe is still, historically high. This is one of the reasons why I'm not interested in this stock. The leverage is a major reason I'm not interested in it. But 8.8% margins, so 7% was used. Worth noting, free cash flow margin has never been negative in all of my data. So that's something, right? This company has never had a negative simple free cash flow margin all the way along here. Look. Goes back to 2013, my data, never negative. So that's a positive sign. You got to get on board with something like that. That means that even when things are bad, they're still generating positive free cash flow. 600 million would be a 7.5 times against market cap, but 27 times against EV. EV really is the killer of this company. If the cycle stabilizes, why has it done that? Oh, it's American, that's why. For simple free cash flow goes close to 1 billion then, which it historically has been. We can see down here, look, free cash flow has historically been around about billion, 1.5 billion, 7 billion, 700 million, 800 million, billion. So, higher than what it is now at the 600 million, which historically has been. The 900 million of simple free cash would be a 5 times market cap and an 18 times EV multiple. Still seems reasonably high compared to historic multiples. So obviously then we got to get on to what would happen to the equity if they paid down some of the debt. Now, with how much was it that's going to be due? How much debt was it? 7 billion within the next 3 years. 600 million free cash flow, 1 billion of cash on the books and 1.7 billion revolver. I've got a funny feeling the revolver also runs out in 2030. Is that this business or is that WPP? I can't remember. It might be WPP. Let's not scroll through that now, because otherwise we'll end up on tangent and ruin this video. So what's a realistic amount to pay out over the next 3 years, given they've got 1.75 billion revolver, still got to pay their costs. They've only made 600 million free cash flow and they got 1 billion. If they stay disciplined, ChatGPT reckon they could realistically pay down around about 1.5 billion. And I agree with that statement. I think any more than that, and you're probably pushing it with the finances, the way the business currently is. So if the EV stay constant, and so basically what people are willing to pay for the multiple stay the same, then the enterprise value would be 16 billion minus what would then be 10.8 billion worth of debt. So we're taking 1.5 billion away from debt, which is currently but it's not 13 billion, right? Because operating leases are in this. So operating leases in my data are added into the total debt, which annoys me a little bit, but it is what it is. I think that's quite common with most of them. So you just got to lump that. But yeah, take my word for it, you'd end up with around 10.8 billion of total debt after paying off 1.5 billion. So if you were to take that away from the 16 billion, you'd have about 5.8 billion in equity value, which is a 35% increase in equity value over 3 years, right? Because obviously they're going to pay this off in 3 years. So that would be a 35% increase in equity value over 3 years if they paid down 2 billion, which is probably on the upper end of what they could do, because a significant portion of this is getting refinanced, I would imagine. That has to be what the bond market thinks if they're close to par value, has to be. But EV remain constant, and there'll be a 40% upside, which is about 11.8% annualized. Stock price is the lowest it's been in 13 years. You know, when was the last time we were down here? Like I said, 2013, literally. So, well, where we are now, here, there. So yeah, 13 years, 2012. Almost 13 years to the day as well that it was last down here. So, you know, there's this. Look at this. Look at where it was. But you've got huge debt load in now, which you didn't have back then. So I've basically said, look, given the risks and the amount of debt in play, there are surely better options out there. The cycle will eventually revert to the mean. Generally, they always do. You know, Howard Marks wrote books on that, and he, you know, mastering the cycle and all that sort of thing. So the cycle will eventually revert to the mean. It is low at the moment, but debt levels will still be painfully high, and this is the problem, right? Given historical prices, it could be good 5 to 10 years or debt levels realistically come down. A return to previous highs before debt loading would be 32% annualized if it happened in 5 years. So we're taking the stock from there right the way back up to 160 odd over the next 5 years if they can pay down the debt. That'd be 32% annualized if it happened in 5 years, which I think is very unlikely, or it'd be 15% annualized if it happened over 10 years, which, you know, yeah, I mean, 10 years into the future is quite a way to look, but if you are a long-term investor, it's not, you know, 50% annualized over 10 years is very fucking good, really, and it's more than double what the market would be, but depends on your time scale. And for me at the moment, where I am in my journey, I'm just not comfortable really betting on this much debt and earnings, you know, forecasting earnings that far into the future. It's just not something that I'm currently interested in. 11.8% annualized, you know, if they paid down the debt in 3 years, you know, that's still better than what the S&P would do, but it's just high risk for me. For where I am in my journey now, it's high risk. Free cash flow levels, where the company is in the cycle of it and how that's impacted free cash flow, it's just not something that I'm interested in. It's not something I'm comfortable with the level of investor that I currently am. You know, 5-10 years time, I might be thinking, oh yeah, bloody hell, 15%, you know, over 10 years is, you know, amazing, which it is amazing. It's very good, right? It is very good over 10 years, right? What's Monish Pabrai is supposedly about 20% over 10 years. So you'd be close to the pantheons of a great investor if you could do 15% over 10 years. Obviously, this is one company, but you know, for me, my level of investing, I can't see far enough into the future yet, especially with debt levels like that, to be comfortable. If there was huge insider buy-in and all that, then I would be interested. And then if there was huge, you know, somebody big came in, you know, saying that they were interested, you know, you'd have to think twice again. But this Turtle Creek Asset Management here, they own 7% of it. Did I talk about that? I don't know if I talked about that. I might just do it quickly because I can't remember talking about it. Go back up here. Less than 1% is owned by the insiders. Like I said, I didn't like that. We have mentioned that. Turtle Creek Asset Management has almost 7% of their portfolio in it. I've got no idea who they are though. 3 other funds are above 2% and 3 are above 1%. Largest owner is Dodge and Cox, who owns 13.9% of CE, but only 0.48% of their portfolio. So only one fund seems to have any real conviction. Now I did look at what Turtle Creek are. Basically say they're a different kind of value investing, but then don't really go into what makes them different. You know, cheaper a company gets, the more we want to own it. I just feel like that's any value investor. I don't see how that's a unique approach. We believe the process of continuous portfolio optimization is superior to a simple buy and hold approach. Okay, so basically, what are they saying there? They want to buy in and out of stuff. I don't really know. We believe we have the right temperament of investing, tested across multiple markets over the last 2 decades. Okay, your returns. What are your returns? It'd be interesting to see, haven't they? If they've what is it? It's by entering this section, you acknowledge and represent that you are a Canadian. No, I'm not. Is it going to show me nothing? No, it can't fucking show me. Look, what a load of shite. Anyway, Turtle Creek, almost 7% of their portfolio in it. Don't really know who they are. They say they're a different value investor, but wanting to buy a lot of something that's cheap is not different than any other value investor that I know of. But there we go. So yeah, put quite a bit of work into this, which is why I've showed it. Not something I'm interested in, but I just thought I might as well put my work out there. Try and see whether or not I can get, networking with a few people. That's what all I'm doing is vlogging my journey, showing people what I see and hoping that I can, meet like-minded people to help me on my journey, because that is what I'm after, really. Anyway, another short form video that's literally lasted 40 minutes again. I'm going to leave it there. Don't invest on anything I say. Really don't. I don't know what I'm doing. I'm very early on in my investing journey, and literally I'm just vlogging my experience. Please don't invest in anything that I say. Speak to your own investment advisors. You got to make up your own mind on things. You're a fucking moron if you listen to somebody on YouTube that's telling you they don't know what they're doing and you invest on it. That's how I feel. But yeah, thank you very much for watching. Please like and subscribe, and I will see you on the next one. Goodbye.